All right. Settle down, everyone. Grab your lukewarm coffee and your slightly too expensive artisanal toast. You're watching Daily Market Narrative, your one-stop shop for making sense of the financial chaos. I'm Dave, and today we're diving headfirst into the big one, the Fed. Yes, the Federal Reserve, that ever so mysterious entity that seems to hold the fate of our portfolios in its interest rate decisions. The dominant narrative, the one that's got everyone glued to their Bloomberg terminals like it's the season finale of a critically acclaimed drama, is all about the Fed's tightrope walk. They're trying to tame inflation, bless their cotton socks, without sending us all spiraling into a recession so deep it makes the last one look like a mild inconvenience. It's a delicate dance, folks, a real high-wire act. So, the bull case, well, it hinges on this idea of a soft landing. Imagine it. Inflation cools down, the economy keeps chugging along, maybe even humming a little tune, and the Fed can start dialing back those interest rates. It's the fairy tale ending we all secretly hope for. Positive economic data, like strong consumer spending or a surprisingly robust job market, can fuel this optimism. It tells us the economy is resilient, it can handle the higher rates, and maybe, just maybe, the Fed doesn't need to be quite as aggressive. But then, and there's always a but, isn't there, the bear case pops its head up. That same strong economic data, it can also be interpreted as a sign that inflation is stickier than a toddler to a lollipop. If the economy's still booming, the Fed might have to keep rates higher for longer, which is, not great for growth stocks, especially those tech darlings whose future earnings are discounted heavily in a higher rate environment. So, strong data can be good and bad, depending on who you ask and whether they've had their morning espresso. It's enough to make you want to invest in a good therapist, honestly. Now, let's talk charts, because apparently squiggly lines can dictate the fate of trillions of dollars. Looking at the SPY, our trusty ETF for the S&P 500, the weekly chart still shows us in an uptrend. It's like that friend who always seems to be doing okay no matter what life throws at them. But on the daily chart, it looks like we've entered a bit of a holding pattern, a pause for breath, waiting for the next big catalyst to send us to, checks notes, 665? Whoa there, that's a big jump. The really crucial stuff, the stuff that'll keep us from tumbling off the cliff, are those support levels at 640 and, more importantly, 620. If we can hold those, maybe we can keep this uptrend party going. If not, well, let's just say the music might stop rather abruptly. All right, let's cut through the noise and look at the headlines that are actually moving the needle, or at least making our trading algorithm sweat. First up, a real doozy from Bloomberg. Trump cranks up power struggle over Fed with plan to fire official. Apparently, the president is reportedly escalating his, let's call it, spirited debate with the Federal Reserve by planning to remove Governor Lisa Cook. This is after he's already made his feelings about interest rates crystal clear, often in very public ways. The administration is apparently looking for any excuse, even something as mundane as building renovations, to justify this. The market impact? Well, this kind of action, questioning the Fed's independence, could send volatility through the roof and make investors, shall we say, a tad nervous. It's like someone trying to fire the referee mid-game because they don't like the calls. Next, also from Bloomberg, Trump says U.S. has much bigger leverage over China on magnets. He's talking about rare earth magnets and how the U.S. has the upper hand, citing airplane parts as a key leverage point. He's implying that if China keeps playing games, like halting magnet shipments, the U.S. could hit back with tariffs. He also mentioned progress on domestic magnet supplies, which is always good to hear. The market impact here? More talk about tariffs and trade disputes, especially with China, can always rattle global supply chains and companies that rely on those materials. So expect a bit of a flutter in the mining and manufacturing sectors. Then we have oil, which is steadies with supply in focus as U.S. to hike tariff on India. So, oil prices are taking a breather, but the U.S. is planning to double tariffs on Indian imports to a whopping 50%. Why? Because India's been buying Russian crude. This is part of a broader effort to influence geopolitical dynamics, particularly around the Russia-Ukraine situation. The market impact? This could mess with oil trade flows and potentially push prices up globally. It also adds another layer to India's already complex dance with both the US and Russia. On a more positive note, Bloomberg reports Korean Air plans Boeing jet order after Lee visit, Lutnick says. Korean Air is looking to order over 100 Boeing jets, a deal worth about $36.2 billion, plus another $13.7 billion for GE aerospace engines. This is their biggest purchase ever and comes after a meeting between the South Korean president and President Trump. The market impact? This is fantastic news for Boeing and GE Aerospace, signaling strong demand in the aerospace sector and potentially giving their stock prices a nice lift. It's also a good sign for US-South Korean economic ties. Shifting gears to Europe, French bond futures are extending their decline on a government crisis, according to Bloomberg. The Prime Minister has called for a confidence vote, which could lead to the government's collapse. This political instability is creating economic uncertainty in France, making it harder to pass budgets and implement reforms. The market impact? This kind of political turmoil in a major European economy usually puts a damper on the broader European markets and can make the euro a bit jittery. Now for some tech drama. Elon Musk is suing Apple and OpenAI, saying they're hurting AI competition. Bloomberg has the scoop. Musk sues Apple, OpenAI, saying they hurt AI competition. Musk alleges that Apple's integration of OpenAI into its systems unfairly favors ChatGPT, squeezing out rivals like his own XAI. He's seeking billions in damages. The market impact? This could lead to some serious legal battles and a closer look from regulators at AI partnerships and App Store policies. It's definitely one to watch for anyone in the AI space. Staying with the business news, Interactive Brokers climbs on replacing Walgreens in S&P 500, as reported by Bloomberg. Interactive Brokers is set to join the prestigious S&P 500, replacing Walgreens, which is, well, apparently not doing as well in the eyes of the index creators. This inclusion is usually good news for the stock, as index funds and ETFs have to buy it. So expect a bit more demand for IBKR shares. And finally, back to President Trump, who vows substantial new tariffs, chip restrictions on countries with digital taxes, according to CNBC. He's threatening big tariffs and chip export restrictions on countries that have digital taxes or regulations that he feels are unfair to U.S. tech companies. The market impact? This adds another layer of potential trade friction, especially in the tech sector, and could lead to retaliatory measures from other countries. So, the trade war narrative is far from over, folks. Now, what's on the economic calendar that's going to make or break our portfolios this week? Well, it's a bit of a mixed bag as usual. We've got a whole slew of durable goods orders data coming out. That's basically a look at how many big-ticket items businesses and consumers are buying. If those numbers are strong, it's good for the economy, but remember, could also mean more inflation fears. We'll also hear from Fed Barkin, and you know how we feel about Fed speeches. Always worth a listen, even if it's just to see if he yawns. Then there's the CB Consumer Confidence Report. If consumers are feeling good, they're more likely to spend, which is great for the economy, but again, you guessed it, potential inflation implications. We've also got the S&P Case-Shiller Home Price Indices, giving us a peek at the housing market, which is always a sensitive indicator. And don't forget the Dallas Fed Services Index and the Richmond Fed Manufacturing and Services Indices. These regional Fed surveys are like an early warning system for broader economic trends. Finally, we've got money supply data and a 2-year note auction, which can give us clues about liquidity and borrowing costs. And for those of you who like your energy news, we'll get the API crude oil stock change. So, plenty to keep the algorithms busy, and us, well, us watching the algorithms. So, there you have it. The market's still caught in that eternal Fed-induced tango between inflation fears and recession hopes. We've got geopolitical spats brewing, tech giants sparring in court, and a whole lot of economic data waiting to be dissected. Remember, it's not about predicting the future. It's about understanding the narrative and how it's shaping today's prices. Keep your eyes open, your risk managed, and I'll see you all tomorrow on Daily Market Narrative. Don't do anything I wouldn't do, which honestly leaves a lot of room for error.